Well, with us now is Martin Ellis, housing economist at Halifax, Bank of Scotland. Thank you so much for joining us. We had that housing price report out just a short while ago, about 13 minutes ago, and we saw actually prices in the UK fall some 0.9% for the month of February. Is this a trend that we're going to see throughout the year?
What we're seeing is sort of monthly fluctuations at the moment, and the February fall really just cancelled out the increase which we reported in January. So prices at the moment are pretty much where they were at the end of last year. If you look at sort of the underlying trend, and we think the best way to do that is just look at the last 3 months, compare it with the previous 3 months, prices are down slightly, just less than 0.5%. And we think that there will be some weakness in the market during the course of this year.
Weakness, I imagine, elsewhere than in London, because London is still being supported by bankers, bonuses and foreigners.
It's certainly right that there are regional differences, and the market is weaker in the sort of the areas outside London and the southeast, and it's right to say there are some special factors at play in London, and the London economy generally is performing better than it is elsewhere in the UK, and that is reflected in terms of what's happening to the housing market in the different parts of the country.
Are we going to see crunch time for the housing market? Is there actually a real risk of collapse if we see a lot of austerity measures and interest rates going significantly higher? At the moment, maybe some people have two houses which they won't be able to afford if interest rates go higher.
Certainly there are risks around to do with the housing market. Our view is that we're likely to see a small fall in house prices this year. By that we mean about 2% across the year as a whole. Now that's pretty modest, and of course that's on the back of some downward pressures on demand. For example, a lot of uncertainty about where the economy is going. Yes, we're seeing higher taxes on the back of austerity measures, and we are seeing very weak income growth. We are seeing signs that people are more reluctant to put properties up for sale on the market, and that's actually improving the balance.
Because they're scared about the future? They just don't know exactly what tomorrow will bring?
They don't know what tomorrow will bring. They're seeing that prices are a little bit softer, thinking, well, unless I need to sell, why should I do it? I'll just draw out of the market. So there's a little bit of a standoff going on at the moment. That will actually help to support prices because it's meaning there aren't lots of properties available for sale. We don't think interest rates are likely to rise sharply. We are expecting sort of a small rise in interest rates during the course of this year. And of course there are lots of risks around what's going to happen to the economy, what's going to happen to interest rates. But in terms of what we think is most likely, we think just a modest rise in interest rates, and that shouldn't really upset the housing market that much, and that is factored into our predictions.
What happens next year? If this year is a little bit tentative and we're seeing the similar gains, not too much lower but not too much higher, is there a risk that if we do see a double-dip recession, then the housing market will be hit the year afterwards?
I suppose that all does depend on how likely you think that sort of double-dip recession is, and if we do go into sort of another recession, then yes, that's got to be bad news for the housing market. It's inevitably going to have repercussions in terms of the demand for houses and people's ability to buy homes. Now, yes, that's certainly a risk. Again, at the moment, we don't think that's the most likely scenario, and we think actually the economy will continue to improve. It'll be a steady improvement, it won't be dramatic, and that would actually help the housing market over the medium term.
Martin Ellis, thank you so much for joining us today.